Mike, I was struck by what you said there, that the policymakers here will have to be talked out of, not into, raising rates here in December. There's a lot you can glean from these minutes, among them tone, and I wonder what insight we have into the tone, the spirit of the debate there that they had at that last meeting in October.
Well, it seemed to be more, David, a discussion of why they shouldn't raise rates at this time. They had gone into the September meeting perhaps expecting that they might be able to raise rates then, but the economy didn't cooperate. The data were slow. We saw overseas developments that concerned them, the dollar, and those diminished over the intermeeting period. And while they weren't quite ready to say it was behind them, they hadn't seen the October jobs report, for example. They were, at this point, still on the path of raising rates sooner rather than later. Whether it would be December or early next year, they hadn't decided yet, but a majority were leaning in that direction, it appears.
And just remind us, Mike, sort of what's happened between that last meeting and when these minutes have come out. You alluded there to the October jobs report. I think of the last time we went through this, the last time the minutes came out, there was such a dramatic difference between what happened in the jobs report the last time. Just give us a sense of the economic indicators we've gotten so far and how that's sort of portended perhaps for more people believing there'll be a rate hike in December.
Well, the two key numbers that have come out so far are obviously the jobs report, not just the fact that we saw unemployment go down and a big gain in jobs, but wages started to go up. And they were talking about how members were reporting companies were suggesting that might be the case. So if that pattern continues in the November report on December 4th, it might lock things in. We also saw the consumer price index go up a little bit this week. Now, we saw the consumer price index fall significantly and the PCE index the Fed watches last year at this time because the oil price collapse happened at that time. That's going to wash out of the year-over-year data in the months ahead, particularly in the next 2 months. And that's why they think that the inflation rate is going to continue to rise even without just seeing an additional slack being taken up by the labor market. So the conditions are sort of moving in the direction they expected. Their forecasts are starting to come true, and they're starting to say, well, it is about time for us to react to that.
You know, Mike, obviously the primary focus here among investors seems to be, when is this going to happen? Is it going to happen in December? Is it going to happen later? I suppose the second question on the heels of that is the pace at which this will happen. Anything in these minutes to indicate sort of how that might unfold when, in fact, it does?
Well, interestingly enough, they had a discussion about both of those items, and they seem rather annoyed that the markets are really focused on the first date rather than the expected path where they end up. And this staff presentation is notable in that they discuss where they might end up based on historical versions of what the equilibrium real rate, the neutral rate, might be. And they say that given the changes in the global economy and the U.S. economy since the financial crisis, that rate is going to be a lot lower than it was. Right now, they say, rates are just a little bit below where the equilibrium rate would suggest they would end up in the short run. And in the long run, they expect them to be lower than historical. So at this point, the Fed is signaling, the staff is signaling, don't look for a significant rate increase over the next couple of years. We're not going to go that far that fast.
Mike, you know better than anyone just how many speeches we've heard from Fed policymakers. We heard from Bill Dudley, the president of the New York Fed, obviously a permanent voting member of that committee, talking about the prospect for raising rates. Let's listen to a little bit of what he had to say.
If we begin to raise interest rates, that's a good thing. That's not a bad thing. That's a sign that the economy is actually returning to health, that the Federal Reserve is getting closer to achieving our dual mandate objectives of maximum sustainable employment and price stability. So, you know, I've often said over the last year or so, I really am looking forward to that day when we begin to normalize monetary policy. I view it as a good thing, not a bad thing.
New York Fed President Bill Dudley saying he looks forward to the day they raise rates. As you've been listening to these policymakers speaking, Mike, over these last few weeks, do you detect much unanimity? Is it pretty fair to say that they're all on the same page when it comes to raising rates?
It's beginning to look that way, particularly among the voting members. We heard from Bill Dudley today. Dennis Lockhart of Atlanta, also speaking today, said he was ready to raise rates at the October meeting. The group wasn't, so he agreed to wait. So he's pretty much on board. He said the conditions, at least on the labor market side, have certainly been met. We heard much the same from Loretta Mester today of Cleveland. And even Robert Kaplan of Dallas didn't suggest that he's opposed, the new member, opposed to raising rates, although he agreed with the idea that the pace of rate increases is going going to be lower in the future. So basically, you've got most of the members of the FOMC at least agreeing that it is about time to consider it. They're going to wait for the final data between now and December 16th, particularly that jobs report. But again, unless they're talked out of it by the data, they're probably going to go ahead, is the sense you get from these minutes.